back in late September, we hit a recent low right around 100, but it's shot up almost without pausing here for the last few weeks here. So we're seeing a very sharp rally in the dollar. And this is, again, coincident with gold and precious metals spiking, which is pretty rare. Hello, everybody. This is John Llodra. I'm a co-founder and partner here at New Harbor Financial Group. I want to dedicate today's timely take on breakout we're seeing in the precious metals space, gold and silver. We've talked about this quite a bit. We've been longtime bulls in precious metals for a lot of different reasons. Here today on Friday, the 18th of October, 2024, we're seeing yet another breakout. Gold has surpassed $2,700 an ounce, new high territory. Silver has surpassed $33 an ounce. It's been quite a while, I think a decade or so since we've seen those levels in silver. So we're seeing a major breakout. We have been talking about this. We've seen a good upside this year to date. There are a lot of factors that are at play here, some of which are traditionally headwinds to gold, frankly, and some are tailwinds. I want to show an article that actually appeared yesterday on the 17th of October. That was a bit of an eye catcher. So this article hit the wires yesterday, and the headline pretty much says it all. Gold is the last safe haven as Treasuries face risk from soaring U.S. debt, says Bank of America. That's a pretty dramatic statement to make. Further goes on to say traders and central banks should increase exposure to gold. They see an upside target of $3,000 an ounce by the end of next year, which would be about a 10% upside from today's. As of yesterday, it was about 11%, but let's call it about 10% upside from today's price. Not huge gains on this forecast, but no slouch either. One of the interesting things about the gold rally of the last year plus is that much of the buying has been during times where things like interest rates and the U.S. dollar have risen. And traditionally, rising interest rates and a rising U.S. dollar are negatives for the gold market. These typically are headwinds when the dollar is rising and interest rates are rising. But the fact that gold has broken out to new all-time highs, just as these traditional headwinds are happening, is pretty remarkable. This is a chart of the U.S. dollar. You can see the dollar index. Back in late September, we hit a recent low right around 100, but it's shot up almost without pausing here for the last few weeks here. So we're seeing a very sharp rally in the dollar. And this is, again, coincident with gold and precious metals spiking, which is pretty rare. If we look at interest rates, this is a chart of the 10-year Treasury yield. We saw a low recently in mid-September of 3.6%, and we've shot up to about 4.1%, give or take. So that's a pretty sharp move in interest rates higher. Again, it's really quite historically not that common to see gold be very strong when both the dollar and interest rates are rising as they are. And in fact, the expectations for Fed rate cuts have come off a bit. The pace at which the market is now expecting for the Fed to drop interest rates isn't nearly as fast as it was just a month ago even, or even a couple of weeks ago. Interestingly, as I mentioned, much of the buying in gold over the last year plus has been by central banks themselves. This is 2024 Central Bank Gold Reserve Survey. So it shows for 2022, 2023, and 2024, what proportion of the reserves by these central banks do you think will be denominated in U.S. dollars 5 years from now? And you can see in each of these years, the preponderance of central banks were seeing that their dollar reserves would be moderately lower at a time when they simultaneously were foreseeing that their reserves in gold would be moderately higher. So it's clear what's been going on underneath the surface here. A shift from central banks moving from dollar reserves to gold reserves. Whole host of reasons for that. Print is kind of hard, but one of the highest stated reason is worried about interest rates here and inflation. So clearly, central banks themselves are very worried about inflation and interest rates and stability. We're now just starting to see, I think, retail buying demand come into precious metals. So we think there's still quite a bit of room to run here in the precious metal space. Now, to be clear, we think too much of a good thing can be a bad thing. And in fact, just a couple of weeks ago, we did book some profits in a nice rally in the gold mining stocks. We still have a model target allocation of about 10%, but just a couple of weeks ago, slightly lower than where we are right now. We rebalanced and took some profits in what was a very strong run in the gold miners, but we still have exposure there. So we're very encouraged to see this. And at the same time, Treasury bonds have sold off, much in line with the comment by Bank of America that gold seemingly is taken on the status as the last reserve. So right now we hold higher gold miner allocations than even we do in Treasuries. long-term treasuries. We only own about a 7.5% allocation of long-term treasuries. We sold that down from 10% just a couple of weeks ago. One might be forgiven for asking is if the gold market has gone too far too fast. And it's always a possibility and perhaps the likelihood when you do move quickly that you get a short-term pullback. But I want to kind of raise this in the context of other assets. Certainly gold has risen a lot, but the broad stock market has as well. That is where we think the real problem lies. The first time ever, the U.S. stock market surpassed 200 on the what's so-called Buffett Indicator. It's the ratio of stock valuations to GDP. Warren Buffett famously articulated many years ago that when that gets above 100, he's really concerned. Well, it's more than double than that now. It's never been this high. And there are other metrics that are very reliable. So the U.S. stock market is really the place that most people should be asking, has it gone too far? And is it due for a setback? We think it's absolutely baked into the cake that we're going to get a major pullback in the U.S. stock market, even though in the present moment, the momentum is very, very strong, and we're likely to see markets power higher here in the near term, but you cannot escape the overvaluation. So yeah, gold has spiked and precious metals has spiked, but relative to other assets, we think they're a critically important part of a properly diversified portfolio. Be happy to talk with clients or any viewers here about their particular situation. We felt this was a very timely topic to bring up, and I want to thank you for watching. Until next time, have a great day.